Accounts receivable and inventory risk. Well, how are you turning over your inventory? That's one of them. And then accounts receivable. If you have a net 30 arrangement, are you collecting net 30 historically? And so if you're going for AR financing, accounts receivable financing, they're going to ask. They're going to get a sample contract, maybe a few sample contracts for some of your big clients. They're going to look at your aging accounts receivable report, which is bucketed, current, 1 to 30, 30 to 60, 60 to 90, 90 plus, 120 plus. They want to know what's collectible and what's not. And are you collecting historically timely? And are these bigger clients? They're going to underwrite in an AR financing capacity, in that context, the strength of that debtor, the client. What is their likelihood of repayment and their likelihood of risk? And they'll even pull the credit of that commercial receivable. They'll do it in bulk to understand, can I feel confident that they're going to pay this invoice? And then they'll forward and advance that invoice. And so you might be net 30, 60, 90. You hear a saying with the government, they always pay, but they pay late. Very, very common. And on Medicaid, Medicare, sometimes in medical, this comes up a lot, of course, too. And depends, obviously, there's nuances like how you're coding and how you're reporting. But it's really understanding what's collectible, what's not, and that, because this is your sales cycle, which also means this is your repayment cycle, your ability to repay and service anything. We want to wrap around that. Do you have a huge bulk concentration in an uncollectible or 120 plus? It happens in business. There's hiccups of all shapes, forms, and one of them could be clients that don't pay you. And that just happens, or they pay late. We hope that you pay. Is it a write-off sometimes? Consult your tax professional when it's uncollectible? Maybe it is, but you want to obviously collect your revenue. You've done the work on it. And so you're doing, is it net 14, net 30, net 60, net 45? And are they paying in congruence with what they've committed? Sometimes they are, sometimes they aren't, sometimes people pay early. It's really understanding this and the bank understanding this and you being able to demonstrate and communicate this, because here is where risk, again, is born. And this can create cash crunches. I'm sure many of you listening, you're being paid late, you're trying to grow, you have salaries to pay. Employment, short-term employment staffing is a great example where you might have to pay for 60 days the employments that you're filling, and you're waiting to be paid, but you've got to pay the salaries of your employees that you're filling on a temporary basis. And so now you've created a cash crunch, but now you've got an even bigger account where you can service even more. But you have the 60-day window here where you're putting out all this capital. You're in a strong position, you're growing, everything, every other metric is phenomenal. You're twice as much revenue as you were last year, but this delay can be this double-edged sword that creates a cash crunch, what I would call artificially. But it's real, it's legitimate, but it's artificial in that the business is strong. And so we've got to cure that. And maybe, is it a product of late paying or non-paying debtors or clients? Or just a product of your sales cycle? And that's a great time and position to have a factoring arrangement or an AR ledgered line where you can advance a receivable at a fair cost of capital, not an aggressive predatory cost of capital. These are great tools. These are great tools that the biggest companies on the planet Earth use. And some of the smaller companies that get concerned because in a factor arrangement, they'll actually be paying the factor company, your clients will be. And so we can understand you'll have a lockbox account, and we'll talk about this a little bit more likely in other videos, but that can feel invasive to your customer base. You feel like that diminishes you, where some of the biggest companies on the planet factor. So these are ways that you can cure these cash crunch cycles, and so having the best accounts receivable, a clean accounts receivable for it, like the P&L. Not weird items out there that are overly aged. Those will cause questions. And again, we always want to be honest. It's important that you're honest. There's a reason my companies, all their names have integrity in it. Very important. So you must be honest. You must be honest in your application. But if you're reporting something that isn't an honest reflection of your business's performance, then you're being dishonest with yourself, and your reflection it's illustrating risk of the business. The business banker, the bank, the lender, the institution, which can be cause for decline. And you want to reduce your risk profile in the eyes of the institution accurately and honestly. So understanding accounts receivable and knowing if that's causing a cash crunch or not. And then of course, having your aging accounts receivable in order, your aging accounts payable in order, your work in progress in order, very important. And there's a lot of great financial instruments in the AR world that can help you so you can continue to grow and not be held back by some of your payment arrangements.